starting the following day, gold has been a tractor in first gear. Uh, and I mean, just from the fundamental standpoint, countries are looking at that occurrence and they're saying, hey, wait a minute. If they can do this to Russia, they can steal our money too. So I think that's the big geopolitical event to look at or point at, which is revalued gold much higher because you've got central banks and sovereign treasuries all over the world trying to unload gold to protect themselves rather than be in a SWIFT system where they can just get shut off.
Yeah, I know what you mean, Bill. And we've even heard some, I think it was the Polish central bank when they were explaining why they were increasing their allocation. Last year was 20% of their reserves. Then only a year later, they're saying, we might need 30%. And they refer to the sanctions, which began in 2022. That's right when the central bank started setting records. And Bill, one thing I would love to get your opinion on is that rather than the talk we heard of Trump ending the war in one day, now we're hearing talk he's threatening more sanctions. And as I had pulled up, as Stephen highlighted with geopolitical uncertainty, now not only are the U.S. to give Ukraine intelligence on long-range energy targets, but also weighing whether to send missiles that could be used in such strikes, which obviously, tragic on a whole variety of levels, but it
Yeah.
doesn't seem like this is going in a good direction, Bill, and anything you've heard, or I know you're quite tuned into these things.
Well, I would just point to the gold price itself. I mean, the rhetoric got turned up, and so did the gold price. I mean, the gold price broke out of that $3,700 cap, and here we are knocking on 4,000. I don't think it's any coincidence that that coincides with the increase in the heat of the rhetoric.
Yeah, and I think, Chris, if you were to do a Google search on articles probably 2 weeks prior to that, or a week prior to that, it was released that they were thinking about sending Tomahawks. And then a week later, the article comes out around, longer range, energy target. So are the two related? Maybe, maybe not.
Yeah, I mean, in either case, obviously, there's the human life perspective, which
Yeah.
not going in a good direction there, and then just strictly from the stance of understanding the gold and silver markets. You saw what happened last time, and if it escalates further, I think that's one of the things that is pressuring gold. Although, Bill, my pit bull, I'm going to throw a big juicy steak in front of him. But everybody pause this. Go get your Bill Holter was right t-shirts. Bill, it's interesting. Now we even have, it's not just people on YouTube who are talking about gold and silver
Right.
supply issues in particular. Here's former JP Morgan Precious Metals Managing Director Robert Gottlieb, who's, I won't go through all of his quotes, but someone who has seen and has access directly to these markets. Silver tightness worsening in London. And Bill, what happened last week and has happened again today that he talks about briefly in here that I think, as you highlighted, India, them doubling imports at this particular time has perhaps exacerbating things, is that the market is now in backwardation, where the spot price in London has now gone over the futures. Here, our dear friend Craig Hemke showing that the same thing happening again today. Obviously, that's an indication of tightness, and thoughts on that, and perhaps anything you could explain to folks what that might mean.
Yeah, that's simply I want my metal and I want it now. I don't want it next month or 3 months or 6 months. I want it now. That's where the buying is, and that's what causes backwardation. Um, what you're seeing worldwide is it's a bank run, except not a bank run. It's a run into metal. It's a run out of paper. I mean, you can look at the US dollar on the USDX, and what is that? That's garbage. You're measuring crap versus crap. But if you measure uh, gold or even gold, silver, or even a cup of coffee, currencies are are quickly losing purchasing power, and that's adding to a lack of confidence in paper.
Yeah, and even on there we go. I'll pull it up right here. Even on Bill's dollar crap index, as he eloquently titled it. Bill, it is interesting that everyone in the Trump administration talking about how overvalued the dollar is. Things gotten absolutely
Right.
torched since they came into office, while Stephen Myron writing papers on how to restructure it and take care of that overvalued dollar, which seems like they're well on their way to. Although the other one for you here, Bill, it's from Bob Coleman and mentions the borrowing fee to short SLV shares just exploded higher. Here's what the chart looks like. It's a bit of a gap, but again, another piece of evidence of the tightness in silver.
Yeah, and Chris, there's one other thing to that piece of news that has come out, and not too many people have talked about, is Goldman Sachs going from their typical 60-40 recommendation between stocks and bonds to 60-20-20, 60 stocks, 20 bonds, and 20% gold. I mean, that's got to be heresy on Wall Street because I mean, during my career on Wall Street, if you said 10%, you were like, that was the absolute most bullish you could be is say, 10, you should put 10% in gold related assets. And here you got Goldman Sachs saying 60-20-20. And obviously that will create more demand.
Well, I can only imagine how perplexed Mohammed El-Arian would have to be to that. Although Mohammed El-Arian, very well-known bond investor who tweets and talks about gold and silver, actually was at the CME dinner in New York a little while ago. And Stephen, one of the things that's been interesting as this has gone along, which was not the case, again, let's call our gold and silver rally beginning of last year. And for the first year, mining stock investors were saying, all right,
Yeah.
that's nice, gold and silver is up, but what about us? Has changed quite a bit this year. And as you and I were discussing before we hit record, at least from the conversations I'm having and what I'm seeing, it seems like even within the past week has
Yeah.
accelerated a bit. And anything you could touch on there.
Yeah, look, as normal, the price pokes up and it continues to poke up on the physical. Then the larger cap miners start to move, then the mid cap miners start to move, and then there's a trickle on down effect into the smaller producers and explorers. And certainly we're starting to see that. The amount of times that we get approached for capital raises, those sort of things has increased exponentially. Everybody comes and says, oh, we have investors willing to invest today um, into your stock. Do you want to issue stock? It's all we're seeing it the price poke up, but we're also seeing people wanting to invest in issuances as opposed to in market. Next, I think we're really going to see them start to really purchase into the market as opposed to into capital raises. Once the capital raise goes through, talking to bankers, there's no more redemptions, or redemptions are now limited in funds. A couple of years ago, and this was a topic of conversation. A lot of these asset managers were still getting redemptions. That's not the case anymore. There's more inflows coming in, so
Right.
that's going to drive demand for stock as well. And as I mentioned, on the physical side, there's lots of people just wanting physical, trying to get their hands on physical any way that they can. Obviously, they're trying to do structured products to get that slight discount. But nonetheless, they're looking to attempt to get physical offtake off a lot of mining assets.
Yeah. And Stephen, would you say that if we had some sort of metric to measure the level of interest or the degree to which money is coming into the sector, that we're beyond what we saw in 2000 in terms of the mining stocks, that this is beyond anything we saw in 2011, or is there any other
Oh, I
parameter?
don't think we're anywhere close yet. I still think when we're looking at it, you got still a lot of people that understand gold. We're just starting to get the tip of the iceberg of the generalist and the family office type of investors. That's what you're starting to see. And I still think we're in the early stages of that. Really early stages of really getting the generalist retail guy into gold stocks.
Okay. And Bill, anything you can share that you've been seeing on the mining side?
Uh, Not so much from the mining side. I'll talk to you from the from the physical metal side because I see that every day. It looks to me like the redemptions, and I mean, we got a mass of redemptions over the last, call it 9 months. I mean, in the last 9 months, I probably got more sellbacks than I did in the prior, call it 15 years combined. And just in the last couple of weeks, and especially in this last week, retail buyers are coming back. And I think I only had maybe a couple sales, 3 sales in the last week.
Yeah.
And I mean, there were weeks where I'd get 15, 18, 20 sales in a week. I'm like, holy cow, it's to watch the price keep going higher, but North America be a seller. The one thing I did take away from that is that there's no money on the streets. And I say that because most of the sales were people telling me, I need to sell because I need the money. I'm running out of cash.
Yeah.
And I think of there's a lot of other evidence. And you can look at credit, you can look at subprime credit, you can look at autos. Obviously, you look at commercial real estate. Look at Las Vegas. Look at the traffic, the flow in Las Vegas. All of these things point, for me, when I look at them, they point to the same thing: is that there's less and less money on the streets. However, there's more and more money in the system. So it's not getting its way to Main Street. The money that they're creating it's going to Wall Street. It's going to financial assets.
You do raise an interesting point there, Bill, is like underlying all of this sort of stuff is not a great economy, essentially, in
Right.
what you're just describing. It's just not a
Exactly.
great economy. And so there's a lot of pain out there, and there's probably more pain to come in from an economic perspective. And that will mean lower interest rates again. Maybe even going down into negative interest rates over time. Who knows where that will go, which is a supporter for gold and that sort of stuff at the same time as printing money. So I look at this sort of area of aspects of things as a business operator in the gold space. I see the price for the end commodity that we're producing higher, which is great, but I don't see inflation. So don't see a lot of
Yeah.
wage inflation. I don't see a lot of commodity inflation like around physicals like steel, for instance, things that are used in general economy. And so you're into this perfect storm of your inputs are going down. Even U.S. tariffs help businesses outside the U.S. because the steel has to go somewhere that isn't going into the United States. And then your product that you're producing or selling is a lot higher. So margins are expanding because the costs are staying the same or going down, and the outputs are going up in price.
Yeah, and of
Sounds
course
like
that
homestake in 19, sounds like homestake in 1930,
Well,
or
look,
I'm sorry,
yeah,
1933, where they revalued gold higher, yet their inputs had crashed.
look, underlying all this sort of stuff was when you look at the history of the world, we only came off the Bretton Woods system in the 70s. That's not a
Right.
long time ago in the history of mankind.
They said it's a long time for a fiat currency. Generally, they don't last more than 30 years, but
Yeah.
because the dollar was the world's reserve currency. I mean, any time that they throw the dollar overboard and change to a new currency, it will be tumultuous.
Yeah, and then add on that again, the infamous, no, I shouldn't say infamous, but Stephen Meyerin, who now part of the Fed and also the chairman of the Council of Economic Advisors, he wrote his thesis on how to restructure this system. So at least they told you it was coming this time. Although, Stephen, one of the things I was hoping you could touch on is that, especially if this environment continues, which certainly there's reason to suggest that it could. What are some of the things to watch out for when you have a situation where, now all of a sudden generalist money starts pouring in, and the mining industry, like any industry, can have things that are not the best policies. So anything people should watch out for as they're looking at mining stocks?
Look, I hope some of the mistakes of the past aren't repeated and that miners in general maintain discipline. So what I mean by that is keeping an eye on cost, not expanding for the sake of expansion. Obviously, we're going to see some mine plans expand as the gold price goes up. Typically, your grade cutoff grade goes down, and your costs will go up as a result because there's not as much cost and not as much revenue in per ton of rock that you're mining, but you're chasing sheer cash flow. So that will have the impact of resetting what I call the base gold price of where it would go in a down market, because all the costs of most producers will go up. But I really hope in this environment people maintain discipline around M&A, maintain discipline around pricing, maintain discipline around cost, and go after, essentially, hopefully increasing margins and increasing cash flow specifically. Because ultimately, the assets will hopefully start to morph into being valued by gold in the ground to a certain degree. That was one of the areas we were in 2011, 2012. But ultimately, you need to be liquid and you need to create cash flow because that's the majority of the valuation across the cycle. It's based on cash flow as opposed to assets in the ground. But you want to keep drill bits in the ground, increase your resource base, which essentially means a lot longer mine life of cash flow. So I hope the discipline is maintained in this market.
Well, I fully appreciate what you're saying, and I'm guessing there will be some places where the discipline is maintained, and that people who have the right risk profile matched up can do really well. I'm sure
Yeah,
there's going to be some places where discipline is thrown out the window, and it looks like
yeah.
Wolf of Wall Street. Bill, you look like, what would you say to that?
Um, as far as the mining shares are concerned, and I think I may have been the last interview I did with you. Uh, Mining shares now are based on uh, they're based on production, based on cash flow.
Yeah.
Historically, I mean, if you go back to 2011, you go back to 1980, you go back to the 80s, 90s, mining companies, uh, there was a value of gold in the ground.
Mm-hmm.
There was a price for value for ounces in the ground. Ounces in the ground now are barely even looked at. And I think that's where we're headed back to again, is that companies are going to be valued based on their reserves. As long as they have enough cash flow to survive and keep afloat and, even enough cash flow to continue drilling. But I think ounces in the ground are going to mean a lot more in the future than they do right now.
Yeah, and Bill, I know you've been telling us that you were an investor in TRX Gold going back a couple of years now. I remember we've discussed it, and perhaps, and it was nice that you've made this introduction. So we have Stephen here who can tell us a bit more about it. But before we hand it to him, maybe you could let people know how it was you found the company and what specifically led you to become an investor and still hold your stake there.
Yeah, I mean, I knew about TRX going back to what, 2003, 4, 5. I mean, it was Jim Sinclair who originally, following him is how I found it. And of course, I partnered with Jim in 2015. Uh, at that point in time, I think there was 600,000 ounces of proven reserves at that point. And a longtime mentor of mine who has a geology background, he looked at the 43101 and he told me, he said, Bill, this thing is pregnant. He goes, I'll eat my hat if it's not multiples of the current 600,000. And I am a property guy. I mean, I'm a value guy. If I buy a house, I'm looking, price per square foot. And that's the way my brain works. And in the mining sector, uh, that's how my brain works as far as reserves. I want reserves in the ground. Of course, the company's got to stay alive to be able to dig those reserves out. But as long as you're in a position where you've got the cash flow to stay alive, which TRX now finally does, and I sleep very well at night, I think that the 2 million, two plus slightly over 2 million ounces of reserves, I think that's going to be much, much higher when all is said and done. And of course, that's my opinion. And I'm talking my book because I do own a substantial position in TRX.
Well, and there we have the website. Stephen, that's quite a
Yeah.
testimonial that he just gave you there. Perhaps for people who are hearing about the company for the first time, you could walk through what you guys have with the Buck Reef Gold Project and active. You're doing exploration, self-funded as well, which is certainly something perhaps you could touch
Yeah.
on, but maybe an overview of what you guys have been doing.
Yeah, so at TRX, we have a mine in the Gator region of Tanzania, and we're into production. We're in open pit mining. We just put out a what I'll call preliminary economic assessment in April. That's brand new. Has a 1.3 billion net asset value at $3,000 gold. So at $4,000 gold, as what we're seeing kind of this morning and around there, it's much higher. And we're producing around 20,000 ounces today, which is going to go higher as well. And that is being produced at around $1,200 cash cost. So the margins are quite good. We're expanding that plant again. Now we've done 3 expansions in the last 3 years. So we're going to expand that plant over 3,000 tons a day. That will enable us to get well over 60,000 ounces per annum, which is going to be great cash flow to reinvest into the drill bit. Our best drill hole results are off of the Buck Reef Main zone. Everything I just described is on Buck Reef Main. Best drill hole results are off of that zone into the Anfield zone and Stanford Bridge. Some of those drill hole results were 200 gram ton meters, which is just absolutely great. And we need to put more money into that and have a much larger drill program, which we plan to do this year. This year was stripping to get the cash flow to go exploring. So what I'll say is we're a production asset that's growing production that will also over time grow resources through the drill bit. So it's an exploration play that's cash flowing. That's the best way to describe it.
Yeah, and Stephen, you said that
Yes.
so far you go ahead, Bill.
Yeah, I was just going to say the reserves are entirely within Buck Reef. The reserves, the stated reserves, don't have anything to do with the 2 new zones that have been found.
No,
Correct?
no, that's correct. So there's a little
Okay.
tiny bit in Stanford Bridge, but not a lot. It all has to do with the Buck Reef Main zone, which has over 100,000 meters drilled on it. The other zones do not have significant meters drilled on it yet.
Okay. And Stephen, you mentioned earlier that in terms of your input cost, you actually haven't seen too much inflation,
No.
different from obviously, I'm sure you saw plenty of it, 2021 to 22, 23, and so on.
Yeah, I would say, look, we haven't seen too much. We saw a little bit. I think North America and the Western world got a lot more inflation than elsewhere. We've managed to keep our costs under control. And part of it too is, yeah, there's some input costs that went up, but as we've scaled production, we get economies of scale. So we haven't been as impacted by it. And we also import a lot from overseas around larger equipment. So we're pretty good at costing things out and getting it in. So we haven't seen a great deal of inflation, and the Tanzanian economy is pretty strong as well. And as I said, they're buying gold, their currency's held up, so we haven't seen those sort of impacts as well. So it's not the inflation isn't the same in that country as elsewhere as a result.
Okay, and Stephen, I was wondering if you could touch on the jurisdictional risk in Tanzania because I think there's when people say, well, mining risk in Africa. Well,
Yeah.
it's a vague question. There's some places that I've found turn out to be great places to be in, others that you may want to have a little premium mixed in there. But what could you say for people who are new to Tanzania?
Yeah, look, what I would say is Africa is not a country. It's made up of many countries with different risk profiles. And so we've had a good experience in Tanzania. I look at jurisdictions as, am I able to get things done in a reasonable time period? And Tanzania, you're able to do that. There's a lot of labor in Tanzania that's familiar with the mining industry, given that it's one of their largest industries. It's over 10% of GDP. Currently, the technical skills are in the country. The suppliers are there. You're able to do things cost effectively. and the government framework around laws and rules and things like that is well established. It is also very high from an environmental perspective, but your permitting timelines are a lot shorter. So look, we've had nothing but a really good experience in Tanzania. And
Okay.
there's a lot of investment going in there. And Perseus is putting in $500 million to Nyanzaga that we see here. Anglo Gold Ashanti's largest mine is in the Gator region. So Barrick has large operations, and there's been a lot of investments going in there. So we're very pleased with the jurisdiction.
Okay, and I guess the last one, Stephen, you mentioned you have the drill program upcoming, and anything you could add on to that, if the timeline is known when you guys are going to start, when people might see results, anything you touch on there?
Yeah, so we've ordered a couple of drill rigs ourselves, so we're going to do a large portion of this program ourselves. And I would expect a drill bit to be put in later this fall and start to see results in the new year.
All right. Well, certainly, with the environment we have in the gold space, sure, I always imagine what it's like because we've lived through the dark times in the mining sector, and I know you have to keep things in check and
Just,
not
Yeah.
imagine gold's going to be $6,000 next year, but I'm sure there's also some fun mornings like today as well.
Yeah, it's easier to wake up on mornings like this when you see that that gold price. So ultimately, the price goes up and down. It will go up over time. There's a lot of factors pushing it. Bill mentioned Jim, and Jim used to have a saying, and you really can't argue against this. He would say, if something as like Bitcoin can go well over 100,000 a unit, what can the world's historical reserve currency go to?
Well, we may be about to find out. So,
It's not really an argument
hey,
against.
Chris, before we finish up, I want to talk a little bit about history, and I'm talking about, 100-year-old history. If
please.
you go back to the early part of the 1900s, uh, believe it or not, mining companies, because gold was pegged, it was pegged at $20 and then revised up to $35. But because gold was pegged, mining companies were actually, if you want to call them, the original utility companies. They traded like utility companies uh, because they had basically a pretty much a known cash flow. You knew what the costs were, you knew what you were going to get for selling your product, and they paid big dividends. And I can envision that once the price of gold gets fully reset, and I don't think we're not even close to that. I mean, I've spoken many times on if you take the the supposed amount of ounces that the U.S. holds and divide it by the debt, only the on books debt, you come up with a number of 135,000. All I'm getting at is the number is much higher when it gets reset. And at that point in time, I think you will see very large dividends coming out of the mining sector because at that point in time, you'll have pretty much uh, a known sale price for your metal. And I'm assuming that governments, more than likely China, the BRICS, they're going to set a price, and the price is going to move a little, going to be like what we've seen in complete free markets. I think that set price, as long as a mining company doesn't go crazy and watches their expenses, I could envision the mining sector again resembling the utility sector. That's just my 2 cents.
Your 2 ounces, Bill? Come on, you gotta get with the times. We don't need cents anymore. It's
Two
Yeah,
cents.
I'd love to get an EBITDA multiple in the utility sector. I'll be a pretty happy man if that's the case.